The share price of Qantas has headed skywards as it announced a turnaround from loss to profit today. In announcing its full-year results, CEO Alan Joyce described the market as volatile, but he remained committed to cost control and repairing the airline's international business. Phil Carey reports.
Summing up the airline business today is, according to Qantas boss Alan Joyce, pretty simple.
There are a whole series of positives and a whole series of negatives, and this typically, I think, happens in an airline of our size.
But according to Joyce, the positives are starting to bear fruit, turning a $245 million loss last year to $5 million profit, or as the airline prefers, a pre-tax profit of $192 million.
Look, there's no doubt that there's an improvement from last year, but it's still a very poor result. The improvement is from a very low base of a profit of around $97 million, so certainly there's an improvement, but the superior metric to use to identify whether the performance is good or not is that profit relative to their asset base, and that continues to be poor.
Nonetheless, investors lapped up Qantas shares today, with the share price up 14%.
This result shows good progress in the group's strategy against a challenging backdrop, with high fuel costs and intense competition.
But cracking open the numbers on what's been described as a strong position by Joyce reveals a few weaknesses. Qantas domestic earnings down $98 million or 21% on last year. Jetstar down $65 million or 32% down on last year. Qantas Freight down 20%. On the positive side, the non-flying Qantas loyalty program saw earnings grow by 13%. Qantas International, while still running a $246 million loss, managed to halve the loss from last year, and Joyce claims it'll get even better soon.
We are 2 years into our 5-year turnaround plan for Qantas International, and we are on track towards our target of returning to profit in financial year 15.
But the airline's former chief economist has a completely opposite view, describing the international business as being in terminal decline.
The reason I think it's in terminal decline is because that segment of the market is in what I call persistent excess supply, so there's always too many seats in the market.
And then there's the soaring cost of fuel, made worse by the lower Aussie dollar.
At current market rates, we expect underlying fuel costs to be $160 million in the first half of this year, higher than in the same period in the prior year.
That, combined with a relatively flat market, may well make the ongoing cost-cutting program that has played a big part in its profit even more crucial in the future.
That number is a very significant number of 19% cost reductions in the last 4 years. There wouldn't be many businesses that have achieved that.
And yet, since its heyday and profits north of $1 billion, the market hasn't shown much confidence in recent years in Qantas.
It's very, very volatile, and shareholders haven't been paid a dividend for 5 years, so if I was a shareholder, I wouldn't be happy.
So today's vote of confidence could be short-lived.